U.S. economy is experiencing death by 1,000 cuts. What's up, everybody? It's me here. So, is the U.S. economy on the brink of disaster? Well, the latest jobs report was pretty decent, but outside of that, everything else seems to be falling apart. From rising credit card debt at record levels to more warnings about the banking system, there's a lot going on that you need to be made aware of. And if you thought things couldn't get much worse, just wait until you see what happened after Jerome Powell signaled one more rate hike before we get to the breaking point. Because despite what it may seem, there's a lot going on behind the scenes that nobody seems to be talking about. And once you understand exactly what's happening, you will see why experts are sounding the alarm. So let's start first with the new data that just came out this week, because it's not good. As most people know by now, our economy has been absolutely crushed by rising prices over these last few years. Everything from food, gas, rent, and services cost significantly more today than they did prior to the pandemic. And even though things have started to come back down, those higher costs are still fresh in everyone's mind. That's why it's really important to understand that consumer spending recently hit another all-time high. That's right. Even with people's wages being completely obliterated and the cost of everyday items still too expensive, people are spending more money than ever before. In fact, retail sales jumped nearly 0.5% in March. And even when excluding autos and gasoline, spending rose for a third straight month, showing that maybe the worst is over. But that might actually be misleading since consumers are now forced to take on record amounts of debt just to keep up with the Joneses. After all, credit card balances increased $9 billion to $948 billion, which was the highest level on record. Car loans also rose to an all-time high of $1.6 trillion as people finance newer and more expensive models. And student loan debt continues to break new records as well, even with payments temporarily paused. When you look at the big picture, it's clear that people are overextended and relying heavily on borrowed money to maintain their lifestyle. And as long as that continues, it could be a recipe for disaster. This is because throughout history, any surge in household debt relative to income has eventually resulted in some sort of financial calamity. In other words, as debt goes up, so does the likelihood of something breaking. And that leads us to the next problem, which is that interest rates are still extremely high. As you probably already know, the Federal Reserve has been hiking interest rates aggressively to try and bring down prices. But that makes it more expensive to borrow money, slowing demand, and causing prices to fall. Except, as you would guess, that has a trickle-down effect across the entire economy. After all, people can't afford homes with 6.5% mortgage rates. Businesses can't justify expansions with a higher cost of capital. And investors won't take chances with a potential recession around the corner. That's why it's no surprise that mortgage applications are down 37% from a year ago, commercial real estate values are plummeting, and the housing market is barely limping along. In fact, Goldman Sachs even warned that we might see unemployment rise as high as 4.6% over the next 12 months, which is the highest level since 2009. And although the Fed says that they are just trying to bring down inflation, the reality is that rate hikes have consequences throughout our entire economy. So even though they think that they're in control, that might not be entirely true. And speaking of inflation, that's also a big concern. As many people might believe that inflation is over, the reality is that it's still a lot higher than what the Fed wants. Even though the CPI has fallen to 5%, that doesn't mean that everything is back to normal. For example, food prices are still up 19% from 2 years ago. Rent is up 9.8% year over year, and the cost of healthcare keeps going up indefinitely. When you account for inflation, that means that your salary would have to increase 7% just to keep up with basic living expenses. But the average raise is only 4%. So in reality, you're making less money than you think. With that said, I am optimistic that inflation will continue to come down over the next few months. But given how high prices got, it'll likely take another year or two to go back down to where they were prior to the pandemic, and that's going to put a lot of pressure on the job market because businesses are going to be hesitant to pay higher wages when their profit margins are being squeezed. Now, even though the March jobs report was better than expected, adding 200,000 positions, there's an underlying issue that very few people talk about. That would be supply chains. Just this week, the New York Times reported that trade between the U.S. and China has collapsed to almost zero, and that has ripple effects throughout our economy. After all, we import hundreds of billions of dollars worth of goods from China every single year, and when those shipments decline, it creates shortages throughout the United States. For example, some manufacturers are running out of essential components from China like computer chips and solar panels, which delays production and raises costs. Or as a coffee shop owner from the article explains, "I've had to find new suppliers. The quality isn't as good and the price is a little bit higher." There's also lead times. Before, I used to be able to call my supplier and say, "I need this by tomorrow," and they would do it. Now I have to plan ahead. This is significant because it shows that shortages and higher input costs are still present throughout the economy, and it's one of the reasons why companies are hesitant to raise prices even further. They're stuck between a rock and a hard place where they either have to accept lower profit margins or pass the buck on to the customer. However, we're starting to see that change as people become more desperate. A recent survey found that small businesses intend to raise prices by an average of 5% over the next 3 months. And a separate survey from the Dallas Federal Reserve found that 65% of firms raised prices over the last 90 days, and 55% expect to increase them further over the next year. Basically, people are slowly losing their purchasing power, and soon they'll have no choice but to tighten their belts even more. Not to mention the added pressure of political instability. If you thought the debt ceiling drama was bad, just wait until September when Republicans will fight over who should be the Speaker of the House. Not to mention Democrats will fight each other on whether or not Israel should be given more funding. All of this points to a future where nothing gets done, and Washington is held hostage by a group of radical extremists. And unfortunately, that's gone to weigh heavy on business leaders and prevent them from investing during a time where we desperately need more growth. Finally, we got to talk about the banking industry, because there's always the fear that more banks are going to collapse. This week, First Republic Bank became the second bank to fail this year, with most of their deposits being transferred to their larger competitor, Bank of America. In addition to that, PacWest and Western Commerce Bancorp saw their stocks plunge, leading to concerns that the worst could happen again. Even though the FDIC said that the banking system is safe and sound, there is a slight chance that a few more banks could go under depending on what happens with commercial real estate. As you probably heard by now, the office vacancy rate is through the roof and landlords are struggling to collect rent. On top of that, there's also the concern that regional banks were caught off guard by rising rates and might have invested in too many illiquid assets. So far, it doesn't look like there's an imminent threat of disaster, but it is something that's worth keeping an eye on. Although what I found the most interesting was a recent paper by the San Francisco Fed, which discusses how widening inequality is creating labor insecurity among low-income households. They found that throughout the pandemic, upper-income households experienced positive wealth changes, while lower-income households saw a net loss. On top of that, people working in lower-wage industries are more likely to be women and minorities, meaning that there's a systemic bias against certain groups that limits their ability to grow. All of this means that even though the economy is technically recovering, there's a lot of tension building underneath the surface. And one wrong move by the Federal Reserve could cause everything to crumble. To be honest, it's not an ideal situation, but as long as people keep spending money, the economy will continue to stay afloat. For now, thanks for watching, and don't forget to subscribe. Hope you have an awesome day.